Hello, everyone, and welcome to another edition of The Officials, the first of the year. And we are an international company, and therefore we have some people in Singapore, me, and my colleagues, Ed and Will from London. And this is the first session for the year. And what we want to share with you is our early observations and where, in our opinion, we're heading from here. Uh, if you have been following our posts, you know that some of us, again me, have been traveling in Asia as well as Greg. And we have, of course, staff here in Singapore as well. But what is more notable for us is what we see in China. China, in our opinion, was coming off the fantastic growth rates they had for many years. And in our opinion, it had hit the wall. Things were not happening there. It seemed like a place frozen in time. Good living, good conditions, but frozen. And that meant to us that energy consumption was going to start shrinking big time, as well as in metals and various other commodities they use in the country. I spent quite a bit of time visiting a few locations there. And the other thing we noticed very strongly, and the data suggested the same, was the move towards EVs. And that meant, again, that energy consumption in the gasoline sector would start coming off rather structurally and not just due to some short term condition in the market. We have changed and modified that point of view somewhat because we have seen a lot of efforts by the Chinese government to pump money into the system. China has essentially two big negatives coming at it. Number one, the economy looks somewhat mature, and mature economies every once in a while go into corrections. And in addition, the uh, coming in of President Trump and his, as we call them, mega MAGA antics. And Trump for sure is going to have a negative impact on China as the tariffs hit growth in that country and production, really. And but we have seen that move by the central government to bring in a lot of liquidity into the country. They have been pumping the systems, changing regulations, lowering interest rates, making sure that people don't have so many encumbrances when they want to buy a house, reducing the quantum required to buy a house. They're doing a lot of things, really. And we have noticed a bounce in some commodity sectors and industrial sectors, as well as growth in car purchasing, which is if you have money, you buy a new car, right? So we are not as negative anymore. And we have also seen in the past couple of months a lot of purchasing of crude oil by the countries. I was talking to a trader a few minutes ago, and he says, yes, they're buying. We're not sure what they're doing with the oil, but yes, they're buying. Well, a market reacts. And if they're buying, prices bottomed out, didn't quite cross as we had expected into the 60s. Now we're in the 76, even 77 ranges. We touched it even if briefly. And this bullish tone will continue, in our opinion, until about close to the Chinese New Year when everything shuts down. And that's between 1 or 2 weeks before the actual New Year celebration. And then after that, what do we see? Well, after that is also turnaround time in Europe and even in China. And that could lead then to a weakening in markets as we enter Q2 and even Q3. And then it very much depends on the global economy. And the global economy, and I'll let my colleagues talk a little bit more in detail about that, is showing really worrisome signs. We're very concerned now about a sovereign debt crisis, and the first entity facing that, well, today is the UK, but before was France and Germany and the US, but today is very much the UK. So before we get too deep into other things, I think I'd like to pass it on to one of my colleagues in London to discuss what they see happening to the UK debt market.
Yeah, thank you, Jorge. So yeah, we had a pretty violent correction in yields yesterday on UK gilts. The 10-year benchmark gilt gained as much as 14 basis points to 4.82%, and longer tenors are at historical levels. And usually what we'd see in this sort of scenario is that attracting capital flow. So, for example, the dollar strength that we're seeing at the moment, a lot of that can be attributed to higher yields on US treasuries. But in the UK, we didn't really see that at all yesterday. In fact, we're seeing more capital flight. The pound is falling as yields are rising, down to 123 yesterday against the dollar. So the market is clearly creaking. There's a lot of concern. There's people talking about the similarities between the default in the 70s and the Truss Kwarteng mini budget catastrophe. And yeah, there's definitely a lot of concern.
We have written a little bit and are becoming more concerned about this sovereign credit risk. The countries are spending too much, borrowing too much, taxing too much, and you cannot increase taxation even further because that will slow down GDP even further and make you borrow even further. So the solution is really, and we were discussing that during lunch, is to have a reset a la Argentina. Mr. Milei is the only one that globally seems to be doing the right thing about abolishing ministries, cutting down all kinds of expenses by the central government. And he is now encountering a budget surplus for the first time in I don't know how many decades. And of course, the Argentinian peso is recovering and the cost of debt is also improving, meaning interest rates are falling, while in the rest of the world, interest rates are going the other way. One of the things pressing as well on markets is what is Mr. soon to be president, but acting like a king already is doing. Some of the expansionist policies, of course, makes a lot of people concerned because they create instability in markets. But one of the issues there is, does he have the money to do what he wants to do, or is he going to print even further? And as he prints even further, the US will need to sell more debt and pay a higher interest, and the US has essentially occupies a very good place where the money rather flow there than, let's say, into the French debt market, and this will create more of a fight for countries in Europe to raise further financing. And this is at the time, and there's a good article in the Financial Times today. This is happening at a time that dependable buyers of debt, as China has been, are no longer so much into buying debt. And nobody should be surprised because we, as being the West, have been beating on the Chinese up like they owe us something. And if they don't buy our debt, then there will be further problems, really. So things are in a flux a little bit. And this is also happening at a time that other markets are also behaving rather strangely. So back to you, Will and Ed, to discuss a little bit on what happened in the electricity markets in the past day, actually.
Yeah, so if a spike in yields wasn't enough to trouble the UK government, then the power market yesterday certainly was. We saw spot power prices jump from around £100 per megawatt hour to over £1,350 per megawatt hour in a matter of hours. In the UK, baseload generation proved insufficient, and there was a pretty catastrophic shortfall in wind generation during peak load hours. If you're going to pursue renewable energy generation, you either need massive storage or you need more traditional generation on standby in order to cover shortfalls. That's idle capacity is always going to be very expensive. So the shift towards renewables is starting to prove problematic, as it has in Germany before and elsewhere.
Yeah, so in Europe, we are facing rising costs of debt, unstable power markets, industries that are shutting down, and I'm on a funk. Is there any bright side in Europe, or am I right in just seeing gray clouds everywhere?
Yeah, it is. When you look at Europe from a macroeconomics or market perspective, it looks pretty bleak. The one bright spark I would say would be Spain, that have led a pretty strong outlier in the macro data recently. Their service sector's doing pretty well. Their inflation's a little bit stronger, and their GDP growth is better than the rest of the pack. But a lot of this stems from tourism, and we've seen Spain say repeatedly that they want to be less reliant on tourism. So the question is, how do you pivot away from that without demand destruction more broadly?
I would summarize our thoughts as follows. We have been more bullish than we have been because we have seen that Chinese demand coming in late December and January. TOTSA, the French entity, has been very good at buying a lot of Dubai. Some people call it a squeeze, and that has led to really hefty premiums for Dubai linked crude and also Dubai in relation to Brent. But that purchasing really reflects the underlying purchasing by China. But as I said, and I'm repeating myself a little bit here, as we go further in time, then we see this slowdown. And it's really going to be a hard fight with the instability that Trump will inevitably bring onto the markets. And markets don't like instability. And also with the ongoing structural reset taking place in Europe, which is rather negative for demand. So if we have Europe kind of creaky and we have China under a cloud because of tariffs and the US sending signals of instability and a debt market sovereign that looks really unhealthy, I'm again struggling to see any bright spots that would signal great markets in commodities as we head, let's say, in 3 to 6 months forward. And that's really where we are analytically. Is not a great time, even if consultants that are closely aligned with OPEC see it differently. Time will tell, but from where we are right now, it really doesn't look good going forward. Any dissenting opinions within the team, or you want to add something extra?
I largely agree on the kind of general broad scale with that, Jorge, that analysis, that short term there is still some rope to run for the Chinese demand, especially given the Saudi-Chinese relationship, which today is the Saudis have just released their new allocations to Chinese refiners for February, and that's still higher than it was in the last couple of months of in November. So the allocations for February are up at 43.5 million barrels, which is higher than the low of 36 that we saw in November. So there is clearly still some demand that the Saudis see coming from China. But generally, I agree that I think the Chinese buying will slow down as we come up to the Chinese New Year. But again, how long can Totsa keep it going? They in December, as you mentioned, they were really, really busy. They bought 35 convergences in the Dubai spot market, and we've heard a lot of that has been going to China. So again, I agree with you that short term there is still some more potential for the bullish side, but within a few 3-4 months, I think we're going to be looking down towards the more bearish side again.
I would also just add that a lot of this spot purchases could be kind of front loading before a yuan devaluation, and trying to get ahead of that currency debasement and buying at a relatively cheaper price for China. Whether it's actually linked to robust fundamental demand or that kind of slightly more speculative purchasing, it's not too clear. The downtrend in Chinese government bond yields doesn't give much optimism for yuan strength moving into next year, but we know China are going to be issuing a lot of debt, which could support the yuan. So yeah.
In terms of these crude purchases, also with China, it's hard to tell where it's going. So I have heard some people saying that a lot of it's just going to storage because they're trying to get ahead of the yuan debasement, which makes sense because they're buying at a cheap price relatively on a dollar basis. So it isn't necessarily kind of organic demand. It's just, like you say, front loading.
Yeah, I think that's the overall sentiment in the marketplace, that is not to buy it, to run it and turn it into needed products, but trying to buy something that will become more expensive on a yuan basis going forward. So with that, dear viewer, we really thank you for your time. I'm sorry to start the year a little bit more bearish than we were anticipating.